Hello, this is Coach here to talk to you about what in the world is going on with the markets. We'll look at this market, which has had the biggest drawdowns kind of in history, the speed of it, and the biggest rise in history. Well, I guess we'd have to go back to the Great Depression for this. We'll talk about what's going to happen with unemployment, probably the recession that's going to happen and what's that going to be like. We'll talk about what the Fed and fiscal policy are doing to come to the rescue. Unfortunately, some of the rescue will result in a larger debt position, so we'll look at that. We'll talk about the coronavirus situation right now and the numbers that are coming out. Whether this economy can come out as a V, U, or L shape, maybe, I'm not saying there is, but possibly there's going to be some impacts on inflations. We'll talk about how that is not priced into the market. We'll also look at what the market is saying. Basically, what is the market saying by rotations in sectors and factors? And we'll also talk about what typical things you see before bottoms are formed. So to start, the S&P 500 is down 21% for the year. Now the S&P 500 is large stocks. It's outperformed small stocks, which are down 34% for the year. Now this is through me writing this right now. And it's actually down more than 20.7% from the high, because the high occurred, kind of halfway between now and the start of the year. So we're down about 25%. But over the last week, we're up 11%. It's like, oh my gosh, over the last week, we're up 11%. I read something or heard something on CNBC that this is the quickest rise since 1929. Could have been 1933. But we've had the biggest drop off and the biggest rise in 90 years, 80 years. It's been huge. Let's take a look at this a little bit more differently. So a bear market is defined as minus 20%. These are different bear markets in history. This one only took 21 days. 1929, the Great Depression, took twice as long. Looking at it on a graphically a different way, here we are. Remember, we ended up down 35%, so this starts at 100. We ended up down here in just a very, very, very short period of time. So what's driving this volatility? I mean, what's doing it? No, sorry, by the way, one more thing. This is the global financial crisis, starting with $1. It took many more days to get to where we are now with that crisis. And everybody talks about that one being really big. This has been quicker than others. The average correction during these bear markets is minus 26%. In the last 7 recessions, 1, 2, 3, 4, 5, 6, 7, the median drawdown was 33%. This one went down 35, 36% already before rebounding, and it's been fast. The fact that companies have become really highly correlated has made this correction really, really fast. This is looking at the S&P 500 correlation, 60 days of various stocks in the S&P 500. This correlation is higher than it's ever been, 0.85. Correlation tends to be higher between stocks when, of course, one thing's driving all stocks. So what's driving all stocks? Worry about the economy. Company-specific things aren't mattering quite as much because the main driver of these stocks is just what's happening in the economy. You'll notice that correlation tends to rise. This was a recession. This was a recession. This was kind of the long-term capital management, some Asia crisis. This was a recession, and this was 1987 when we had the biggest one-day drawdown. Diversification doesn't really work for portfolios too well when all the stocks are correlated. There's a couple of technical kind of indicators that may be causing stocks to be um, more correlated. Let's first take you to the derivatives market. Now, I'll admit, I'm not an expert at derivatives. So I spent a few hours today just looking for certain examples on this. I read an article in Bloomberg, and the article in Bloomberg was talking about how the dealers that are selling put options, the act of them selling put options, and people would buy a put option, you buy a put, it gives you the ability to sell a stock at a certain level, even if it goes down. But the fact that they're selling put options, that could be creating even more volatility in the underlying. So bear with me as I go through this example with you. And again, I'm not a derivatives expert, but I read this article and I believe they were quoting one of the strategists at the big banks and what they were saying. So let me go through this with help you understand it. So someone probably would buy a put if the markets are going down. Because again, let's say, let's give you this example. Let's say someone buys a put that gives an ability to sell at 70. Well, they paid a dealer who sells the put $2 for that. If the stock goes below 70, thinking about it was probably 80 and falls to 70 and they want to protect themselves even more further downside. If the stock goes below 70, the one that bought the put can still sell it at 70. But the one that wrote the ability, so they wrote the put, they don't want the stock to go down. Because if the stock goes down below 70, they have to sell it at 70, even if the stock's at 60, that's a bad thing. So the one that writes the put is basically betting the stock doesn't go down further, they're betting the stock goes up. So the dealer who writes the put has a long bet. But a dealer doesn't want to make a long bet. They want to be net neutral no matter what the stock does. So in order to offset the long bet of selling the put, they have to go sell the shares. So let's say the shares are at 72 and they sell 1,000 shares at 72 to offset their net long bet on selling the put. Let's come down and look at the payoff of this situation. So stock's at $72. If it stays at $72 at the time of expiration to put, the put gives you the ability to sell at 70. The ones that bought the put don't exercise it, so you collect $2. Well, $2 on 10 option contracts, 100 multiplier, that's $2,000, okay? Now, where does the dealer make more money? Well, okay, well, if the stock, remember they shorted the stock. So if the stock falls $2, so if the stock goes down $2, they get the benefit of writing the put, plus if the stock goes down $2, they sold it at 72, stock goes to 70, at the end of the option, they close out their trade, they can sell, they shorted at 72, they buy it back at 70 to make $2 on 1,000 shares, they collect another $2,000, so their profit is $4,000. And by the way, it's stable if the stock keeps going down because they've shorted a stock, which they will gain on the short, but they'll lose on selling the put if it keeps on falling below 70. Now, remember when the person bought the put, the dealer, sold the put, they had a net long position, they had to push the stock down, all right? So the stock just got knocked around. And probably the reason why someone's buying the put anyway is the stock was down in the first place. So there's a huge selling pressure that caused the stock to originally go down, which caused the person to buy the put. And then the dealer pushes it down more. Well, if it gets pushed down so much, that's an overreaction. So what will happen the next day if it overreacted negatively? Well, it goes up. Well, the dealer has a cushion. Remember, they collect this $2,000 in premium. All right. Now, if the stock goes up, the premium for the person who bought it expires worthless. They still collect the 2,000, but they sold short the stock. So if the stock rises to 74, they lose $2 times 1,000 shares on the short, and their profit goes to zero. Now, they don't want the profit to go less than zero. So they don't want to be negative. So in order to protect yourself, if the stock goes above 74, because they sold short this, and the higher it goes, your losses are unlimited, what do they have to do in order to protect themselves so they don't lose any more money? They got to buy back the stock. So they reversed their short by buying back the stock. Remember, they lost, their profit became zero because the stock was going up. And by buying the stock, in order to make sure you don't go down into zero, less than zero, it pushes up the stock more. We've had incredible volatility. We've had actually many, many days in the stock market over the last month where the stock market goes way down one day, just to rise way more than another day. Possibly part of that's due to this. All right, let's talk about a couple more things that could be driving the extreme volatility. We're here on my outline. So there's something called a risk parity strategy. So in risk parity, organization, a firm targets a standard deviation of returns. So let's say you're targeting a 12% standard deviation. And by the way, standard deviation is just blowing out really high recently for stocks. So let's say you're targeting a 12% standard deviation for your client. In order to hit a 12% standard deviation normal times, let's just say that you have to have 50% stocks, 50% bonds. Bonds have a lower standard deviation, stocks have a higher standard deviation. But when markets go down, correlation becomes higher, volatility becomes way higher, so the stock volatility goes way up. Well, you still told your client you're going to target 12% standard deviation. The stock volatility went way up. So instead of having 50% of stocks, 50% of bonds, I got to sell stocks because they become so volatile, and I got to buy bonds. Well, the whole reason why you've gotten all this volatility is because stocks are down. Now I got to sell stocks. And then it pushes them down even more. And by the way, some of these risk parity strategies could have been levered. So they could be having these margin calls or whatever's going on, which just causes us to unravel very, very quickly. Let's throw in one more factor. It used to be most of the money by institutions was handed to professional money managers that are looking through stocks, finding ones that are unreasonably down, unreasonably overvalued, and they would basically, probably the ones that are way down, they say, hey, that's too cheap. They would be in there buying. And the ones that are up a lot, maybe they would be in there selling because they've hit their full value. But the amount of money that's moved to exchange traded funds and indexing is growing really, really high. There's less fundamental active money managers in order to, offset some of the huge movements. And that could be causing more movements because there's no buyers, the fundamental active managers, to provide a floor. So we got a huge amount of volatility, typically when we have recessions. And some of these underlying like technical things, who's doing the, moving the markets, or just creating, don't need to go on a roller coaster, just go in the stock market. Let's move on and talk about what's happening with unemployment. Obviously, the market's been moving down because they're worried about a recession. This is unemployment claims yesterday. The shaded is recessions. Recession claims. We had over 3 million people in the last week file for unemployment. Okay, it's 3 million people, right? There's 300 and some million people in the US. That means 1% of the population lost their job in the last week. It's more than that. It's more than that because not all the 350 million or so in the United States are employed. So maybe it's more like 2% or more lost their job in 1 week. Jeez, we know unemployment must be rising. So let's look at what unemployment does in a typical recession. So here we are right now. This is after the claims that came out yesterday at 3 million. It looks like we're a little bit close to 5%. It peaked at around 10% in the Great Financial Crisis. You can see what it did in the Great Depression. That's pretty depressing. So where are we going? Okay, well, we have surveys on what people think is going to happen. And right now, what will be the peak level of US unemployment rate over the next year? This is percent of respondents, a survey done this week. You can see it's like 10, 15%, somewhere around 10%. So does this make sense that we're going to go to 10% that quickly, which is equivalent to the great financial crisis? Well, let's think about everybody having to work from home. What percent of people can work from home? So who can work from home and who cannot? All right, well, let's do this. Management, business, and financial services, 60% of us, probably the profession if you're watching this, can work from home. Production, 4%. Transportation, 3%. Services, which are being really hurt, 6%. Now, we look at this, workers who could work at home, share of total employment. Financial activities, 57%. Leisure hospitalities, only 9% of those people can work from home. And that's one of the biggest that are being hurt right now. Let's look at by income category. People who are in the higher income categories can work from home. People who are in the lower income categories really can't work from home. So this recession that we're having and telling people they have to stay home is hurting disproportionately the people at the bottom end of the pay scale. Look at what's happened to activity in some of these areas. This is number of flights. This is millions in flights. This is global. And now look at what it's dropped off to. Well, it should be about 170, 180 million right now to 100 million. Subway fare swipes in New York, I think this metropolitan area. This is as a percent of 100%. We've fallen quite a bit. Probably will fall even more. Where are people working? So this is percent of non-farm payroll. Food services makes up 8% of employment in the country. This is in, I think, millions, if I remember right. Hospitality, it's about 16, 17 million people. Most all of them are going to be out of work. So if you just think if 75% of these people lose their job, this is percent of payroll employment, that's 6% on top of some that already lost their job. Yeah, we can get to 10% pretty darn quickly. This is arts, entertainment, recreation. They're gone. Combination, well, they're pretty much gone too, unless you take some of these hotels and make into hospitals. Motor vehicle parts and dealers, well, Ford, GM, and all those have shut down their operations. So you can see where this survey here, greater than 10%, While we have a rescue package, it's going to rise very, very quickly for a few months at least. So let's go back to my outline. We've kind of now looked at what's happening about unemployment. Now let's look at, kind of history of recessions, okay? And we'll talk about the math of what could, what could happen today. We'll give you a few other statistics. So the history of recessions, the worst GDP quarter in history was in first quarter of 1958, where we were down 10% in a quarter. Could we be worse than 10% right now? Think about the math that I'm about to give you. All right, so in the United States, consumer spending is about 2/3 of the economy. I believe it was a McKinsey piece I read recently that said about a half of consumer spending is discretionary spending. Leisure, restaurants, entertainment, things you don't need, that's not associated with healthcare, not associated with going to the grocery store. So let's say that's about half, right? So you take, let's say 70%, you divide it by 2, that's 35% of the economy. 70% of the economy is consumer, half of that's discretionary. So 35% of the economy is discretionary. Okay, so if 35% of the economy is discretionary, and a lot of that's, these things that we can't do because we're staying at home. Let's say the discretionary, which is 35%, is cut in half. Well, half of 35% is 17.5% drop in GDP in a quarter. Of course, this really started happening pretty strongly, most of the way through the first quarter of 2020 in the US. So it's not going to have as great of impact this quarter, but second quarter, depending on how quickly we can get people back to work and spending, which it could go through most of the second quarter, we can definitely see GDP prints at least minus 10%. Because think about it, people aren't spending because they can't, sitting at home, but GDP is also, people, there's a business spending too. That's a component of it. There's a housing spending that's a component of it. All those things are also going to be slowing. So yes, we could easily have more than 10% drop in GDP in a quarter. Let's look at typical drawdowns during past EPS corrections. The typical drawdown in earnings per share is 21%. You can see the recession here, it went down, 92%. The one, kind of the earlier 2000, 54%. The 81% here. The Great Depression, 75%. So, well, 21% may not be too reasonable, given that some of the biggest recessions have been associated with larger drawdowns. With that being said, possibly this one's going to be short-lived, which basically will mean that we only have a partial year of that huge drawdown. So that's what we could hope for. So what's the market pricing in? Let's go over to FactSet and see. This is Standard & Poor's 500 earnings scorecard. Let's look at the last quarter. We really didn't have growth in 2019. It was pretty much flat growth for the year. Reported growth in the fourth quarter was like 1%. The estimates a few months earlier, before the quarter, were 2%. What are we expecting for Q1 this year? Well, back in September, people were expecting a rebound in growth in Q1 to 7%. Now we've dropped to minus 4%. What are some of the biggest ones? Energy went from plus 46% expected growth to minus 38. Industrials went plus 8 to minus 24. Materials +2 to -21. Why all these big drops? We gotta, oil prices have fallen both because of the recession, reduction in demand, and Saudi Arabia and Russia, basically pumping up production. And maybe, they're kind of in a war with each other on this, and they're also trying to drive U.S. Shale plays out of business. And that very well could happen. I heard someone who is in the shale play, that area figured a huge portion of companies will go bankrupt over the next year. Now, the other big movement down is consumer discretionary, right? 5% to -18%, because those are discretionary expenditures that we don't necessarily need to have right now. And they include things like automobiles. They were supposed to be -5% growth. Now it's -54% in this quarter. Now, on the other hand, consumer staples, it was 4, only went to -1. Now, a lot of the staples grocery store retailers are doing really, really well right now. Now, going to second quarter, you see also a big drop off in earnings growth. Now, again, companies may not even be giving guidance right now, so these numbers could be way worse, and these are sell-side analyst expectations. But we've only dropped off 4% and 7%, and this year, back, so this is 2019. Let me pull this up for you. So here's 2020. We went from expecting 9% earnings growth for the year in December to only 0 now. So basically what this tells you is that people are expecting a big rebound come the third and fourth quarter, or analysts are just frozen, companies are just frozen, and they just haven't changed their numbers yet. Because I got to think, personal opinion, that these numbers are not low enough. If people really do believe these numbers, then the market could be in for a further revision down, and revisions and stock prices tend to move together, which means the market could be in for a more negative surprise and more downdraft. Let's go back to my outline. So we have people to the rescue. We have the Fed to the rescue, and we have fiscal policy to the rescue. Let's talk about the Fed first. I'm going to start by talking about how money is normally created in the system for mortgages and what the Fed's been trying to do in order to shore up all kinds of different areas of the market. So this is an article in Bloomberg. By the way, this is the same article I read when I started learning about what's happening in that derivatives markets causing the volatility. So if you look at the URL here, you can go to where I got the source for the other idea. This is the typical way, though, mortgages are created in a traditional banking system. You put your money in a bank account, it pays you a little interest, and you can take out your money anytime. The bank then takes your money and lends to your neighbors to buy a house. The lending rate on the house is higher than they pay you on the interest. The bank makes money. That's the way it used to be. Now, this is the modern banking system. The reason why I'm showing you this is because the Fed has come to the rescue of all kinds of plans, basically to shore up every single one of these areas. So you put your money in a money market account. So you have an investment account. You don't have all your money in stocks and bonds. So what's sitting in cash is in a money market account. It pays you a little bit of interest. You can take your money out of that money market account, money market fund anytime. Now that money market fund pays you a little interest. And what do they do with their money? They lend your money to a big dealer bank in the repo market. Now, in the repo market, so they borrow this money from the money market fund and they collateralize that loan that they got from you, you're the money market investor, by treasury bonds, okay? So basically, if they can't pay you back, you got the treasury bonds and mortgage-backed securities. Now, this repo market, they can take their money back anytime from who they give it to, okay? So What does the repo market do? Well, this dealer in the repo market lends money in the repo market to let's say a mortgage real estate investment trust. So a mortgage real estate investment trust borrows that money, pays the repo a little bit of interest, and they collateralize their loans with REITs, mortgage-backed securities. So what does this one do with their money? So they have to pay a little interest in the repo market, and this mortgage real estate investment trust takes the money and they uses the money to buy mortgage bonds from mortgage lenders. Now, keep in mind, the repo market can take their money back from this REIT mortgage-backed trust pretty quickly, anytime they want. So the mortgage REIT, okay, again, uses the money to buy mortgages, bonds from the mortgage detailers, mortgage lenders. Generally, can't get its money back, but it can sell the bonds to raise money. All right, so these mortgage lenders get the money from, let's say, the mortgage REIT, and the lenders get the money, and they use that money to make mortgages to your neighbors, and they pay interest, and all that comes back through the system. Okay, so the markets have been basically frozen in every one of these. No one right now, and I'll show you the data on this a little bit later, is really willing to lend anyone to buy a home. Basically, the bank's not willing to lend for someone to buy a home because they have absolutely no idea what that home is actually going to be worth. We're in a situation where it's very hard to predict the future, a situation where we could have the worst GDP print that we've had, at least since 1958. So they're not going to lend out. Okay, that's bad. And that's very bad because the housing market then freezes up even more. Okay, well, this mortgage REIT one is not really going to lend to the bank, even if they were willing to lend to the person taking out the mortgage, because they're worried that the bank, if they lend unwisely, they won't get their money back. So no, they're not going to lend down here. And the dealer who lent to the mortgage real estate trust, they're going to want their money back too, because they realize the mortgage REIT is buying mortgage bonds and people are going to be out of job with extremely high unemployment rate, and they're not going to be able to pay their mortgage, which means they're going to have some losses on these bonds, these mortgage REITs. And if they have losses, then the repo market, big dealer bank's going to worry that the mortgage, one that owes them the money is not going to be able to pay it off on time. So they're going to take their money back. All right, well, you in the money market fund realize that the big dealer bank who's lent money in the repo market, this is all associated with mortgages, you don't even want money in a safe money market fund. You're going to take your money out of the money market fund and just plunk it in good old cash. And you don't care about it paying you a little interest because you just want the cash. The whole system starts freezing up. The Fed has gone out. It's just incredible. They took out the 2019 playbook and they did it all within 2 weeks to be able to provide liquidity to the repo market, money market, all these different points along the way in order to unfreeze the markets. Let me give you an idea of the cash infusion that came with the recent deal. That was just signed today. Today is March 27th, 2020. The House just assigned what went through the Senate, and I assume that the President Trump will sign it. So part of this deal, $2 trillion relief package, allows the Treasury to put up $454 billion in order to fund businesses directly. But that $450 billion is really more like 4 to 5 trillion in loans. Let me show you how this works. So basically, the Fed can't lend directly to corporations. It's not allowed. So in order to Fed to be able to lend 4 or 5 trillion, they had to work with the Treasury Department. And the Treasury Department is on the hook for 454 billion in losses. So what the Fed did with the Treasury, which is approved by Congress, is the Treasury says, all right, Fed, go ahead and lend. And since you can't lend directly to corporations, set up a special purpose vehicle that can, and we'll fund that special purpose vehicle with 450 billion or 54 billion in equity. Okay. Now the Fed's balance sheet looks like this. Let's take a step back. So the Fed then takes that 454 billion in equity. They say, well, you know what? If we lend out to corporations, only 10% of them will default. We'll only lose 10% on it. So you take that 454 billion and you divide by what the Fed figures, because the Fed's not allowed to lose money on this, okay? So you take the 454 billion and you say, well, you're going to lose, what number allows you to lose 10%, all covered by the Treasury before the Fed loses anything? Well, you take 450 billion divided by 0.1, that's $4.5 trillion in lending. The Fed, Powell's come out and said, we have unlimited lending. If this isn't enough, we'll lend even more. So basically, they're showing up corporate America. Now, these come with some strings attached. Anyone that takes this lending facility in order to get through maybe the next few months where people aren't working, like hotels, restaurant, leisure, that type of thing, they have to keep their employment levels. I can't remember if it's 80, 90% of what it was on Monday this week or something like that. They can't fire the people. So that protects the people's jobs. They are only doing this for companies that are investment grade. We'll get to why that's a problem a little bit later, but they could always change that. But this is basically the Fed shoring up corporations, which, and by the way, it's 5 years, so it's short-term lending. And the interest rate, I believe that's going to be charged is what they could have been able to borrow at before, this crisis. So it's reasonable lending rates as well. Now, the problem with all this is we're going to push a huge amount of debt onto corporations. And as I'm going to show you later, they're already extremely levered. Okay. It's not just the US Fed doing this quantitative easing, pumping up the system, putting money in the banks, money market funds, repo market, et cetera, and then now direct lending to corporations. This is happening all around the world. This is global short rates. They've just fallen apart. They were already very easy. The reason why they were easy because we were, kind of having a manufacturing recession right before this coronavirus crisis. And now they just fallen. Every central bank around the world is doing their best in order to shore up the markets. This is the Fed's balance sheet. In the last couple weeks, it went to maybe $4.5 trillion. Okay. Projected Evercore ISI, 10 trillion in a very short period of time. ECB, Bank of Japan, they're all doing this. Does this normally work? Becomes the question. Will this work? Well, I have a model that looks at the quantitative easing, the cash going in the system, and whether this normally works. And this model is right here. And I've written about this on my website in the past. This is the black line is the ISM manufacturing index, a gauge of the manufacturing economy. If it's greater than 50, that means you're expanding. If it's less than 50, you're contracting. And then I have money supply, quantitative easing, minus GDP growth. If money supply is growing greater than GDP growth, that money's got to go someplace. So basically this will end up in prices in the economy, make GDP growth go up through prices. It'll end up making real GDP growth go up, which is quantity, or the money will be stored and stocked into cash and stocks and various other things. So there's a velocity of money. But you can see that money supply tends to lead the ISM index, which is a pretty good gauge of the economy. And it was growing really, really quickly. This is through last month, by the way. It was growing really quickly, which you would have thought the economy was about to pick up. So it was kind of bottoming, about to pick up. Now this money supply is probably someplace up here. So, you know, don't fight the Fed. That normally works that way. Okay. Now the second part that's U.S. is doing and other countries are doing is fiscal policy. So let's look at the size of the fiscal packages. So first of all, we had this 454 billion, which I tell you is really more like 4 or 5 trillion in lending for corporations. We have some directly to the airline industry. Boeing got down to in the 90s, 95, 97. Yesterday, I think it closed at nearly $180. It's at 162 right now, down 18. It closed at $180, up 80% in a few days. That's how much fiscal policy can make a difference. 8 billion for air cargo, 17 billion for national security industries, and we have this 454, which we talked about earlier. By the way, these are some of the things that are required if you're going to get that financing. No alternative financing is reasonably available, probably wouldn't be. Duration not more than 5 years, loan is secured or made at an interest rate that reflects the risk of the loan. I think that's before, again, the crisis. You can't do any stock buybacks during the duration of the loan. I believe you're not going to be forgiven a loan, which is a huge problem we'll come up with really soon, I'll tell you about. You must maintain your employment levels in order to get this. And by the way, they limit executive compensation. I think they're also going to say no dividends. So this was maybe published before the final version. They're also going to lend money to mid-sized businesses. So we got small business reliefs. And then what are they going to do for individuals? Payroll relief. For employers, don't have to pay your payroll taxes for up to 2 years. Individual checks, 300 billion. 1,200 per individual or 2,400 for family, 500 for each child. They're going to give you more unemployment insurance, $600 a week. Now, think of $600 per week. There's 50 weeks in a year. That's $30,000 that we're going to be basically insuring people for. I don't know how many months this is, but they're basically going to insure them for about $30,000. That's on top of the existing unemployment insurance. So I was looking this up for Wisconsin, you know, where I live, trying to figure out what is the normal unemployment insurance. I think it was like 48% for, I don't know how many months it is, 3-4 months. So let's say you make $30,000, and remember, it's the people at the low end that need this the most, the ones that can't work from home. Let's say you make $30,000. You're going to get half of that, maybe just through normal unemployment insurance, $15,000, you know, on an annual basis, plus the $30,000. It got into a snag earlier this week, I think it was Monday, because people realized the people at the low end, they could be making actually a higher amount of salary with this bill than they were before. I think this went through anyway, just because we needed to get something through. 150 billion for state and locals, 100 billion for hospitals. And by the way, this is like number 3. I can't remember how many bills there are now. There could be a 4th one if this isn't enough. So this is them going all in. Now the market has rallied very significantly on the Fed doing this and the fiscal policy very, very quickly. I told you like 12% just this week. The Fed announced a lot of their additional policies on Monday. In the great financial crisis, something like this for 800 billion, this is 2 trillion, took months, 2 months. They wanted to balance the budget. They were worried about the debt. The Fed took a lot of time to come up with all the different things they're going to do. They basically just threw it all in now and they're adding some additional things. All right, now, the problem with our FITs is our debt situation to begin with. Basically, in order to get us out of here, the government's going to take on way more debt, and the Fed's going to fund corporations taking on more debt. Now, it wouldn't be such a bad thing if we would have saved for a rainy day. The debt situation is already really bad. So let me take you to a presentation I had on my website a year or two ago. It's still there. So these are a bunch of graphs just looking at, this is about a year old, looking at the debt situation across the government, businesses, consumers, and banks. So this is the total amount of debt at the peak of the financial crisis as a percent of sales of the economy. So that's like GDP. This is where we were a year ago. By the way, it started to go back up a little bit higher. So we really are not really any better on the debt situation, maybe a tiny bit better than we were in the financial crisis, and now we're just going to leverage up way more. This is debt, the federal debt to GDP over time. This goes back to 71. It's here. These bailouts, $2 trillion. And it's more than that because you got all the unemployment insurance initially. Basically, let's just say this is going here. This line over here looks at the debt of corporations as a percent of GDP. That was just before recession. That was just before a recession. That was just before a recession. Notice that we tend to peak out. We have the most debt to GDP in the business side. These are non-bank businesses just before a recession. This probably going to there. Now, a lot of people said this was not such a bad position because, debt to GDP for businesses, non-financial, were high, but debt to profits, which is the blue line, wasn't that high. Now, notice when these things spike, these are all recession when the profits go down. So now that the profits go down, this is like this. So I'd argue that this was kind of high. And the only reason why this wasn't necessarily even why corporations could handle it is because the interest rates come down. So basically the Fed solved the last financial crisis and basically propped up the economy and allowed people to borrow more and more. Basically it was businesses, non-bank businesses and the federal side borrow more by lowering interest rate. So basically we solved the financial crisis here by lowering interest rate and allowing corporations and the government to lever up even more. Now, that being said, banks have delevered and households have also delevered. This is something called a financial obligation ratio. Basically looks at interest payments, mortgage payments, I think insurance payments, things like you have to do as a percent of your disposable income. Now, I don't think this is percent of, this looks low. Now, partly the reason why this is low is because interest rates went down. If interest rates weren't down, we'd probably be right around there. Now, remember, everybody's fully employed. Now, assuming it's percent of aggregate disposable income for the whole country, assuming that, the denominator is really high because everybody was employed. And the numerator, the mandatory payments were low because interest rates are low. So if you take this back to more maybe a normal unemployment, maybe we were right around here, which means they weren't as good a shape as you would maybe think they were, right? Now, this is something that's been bothering me for some time. A few years ago, we reduced our taxes in the country. Corporations even gave personal some lower taxes. Tends to be when the unemployment rate is low, your deficit, this is basically your tax revenue minus your payments by the government as a percent of nominal GDP. Typically, that deficit, this is negative numbers, goes down, and you at this low of unemployment, you basically be balancing the budget. This is where we were at 1018. I have another paper on the website that looks where it was, a month ago. We're like here. So we're basically running a huge deficit in a very good time, which is very unusual. So instead of looking at it as a scatter plot, look at it in this line graph. You can see when our unemployment goes down, you typically start rising, basically a surplus. This is the tax cut. You would think the federal government can't afford this extra deficit. However, as long as the Fed's out there and buying up the bonds the Treasury's issuing, I suppose you can keep rates low and you can afford it. There's going to be coming a day of reckoning sometime in the future. I don't know if it's 2 years, 5 years, 10 years, where the amount of interest payments on this debt is going to be so overwhelming that it's going to crowd out the ability of the government to spend, and they're going to have to cut spending. Let's look at corporations. I already told you that corporations are reasonably levered up. Maybe not as percent of profits, but profits are going down now. Profits, this is all profits, including small companies, non-public, as a percent of GDP, profit margins are very high. So when we had these profits and this debt was going up, what were corporations using it for? This looks at S&P 500 uses of cash over time. The red line here is share buybacks. You notice the red bars are becoming larger. So a lot of this debt that was raised here at really low rates was used to buy back shares, which really are not really growth expenditures to grow the economy. So we have a debt situation in corporations that is, maybe benefited shareholders because this is a distribution of cash to shareholders, but really didn't benefit growth. All right, now the Fed, when they're buying up these bonds, the 4 or 5 trillion, they're not buying up junk bonds, okay? So there's a junk bond market. They basically are limiting it to investment grade bonds, bonds that are rated BBB and above, okay? This is the amount, this is 2017, so this has continued to grow, the amount of BBB bonds. And this is bonds above BBB, and this is high yield junk, which they're not buying. That was about 22% of the bonds. This is the rest. But BBB bonds are bonds that are like just a couple notches, BBB minus than junk, above going into the junk category, which is considered speculative, which frankly, a lot of professional fund managers are not allowed to buy because pension funds and others may have certain requirements to be investment grade. When you go to junk, interest rates rise quite substantially. If you look at this amount that's BBB, just above going to junk, and you compare it to the total amount of public debt in 2007 that was investment grade, which is the BBB and the other investment grade, it's actually more. You have more debt that's just above junk than you had of all investment grade before that last financial crisis. All right, that's a bad story. It's going to get way worse because they're going to take out all this additional debt. But I'm sorry, the story actually gets even worse than that. 2017, there's debt supporting speculative borrowers, so that would be the high yield. This is the cash supporting. It was just 12% in 2017, below 14% during the crisis. The BBB debt, the net leverage ratio is 2.9 versus 1.7 at the peak of the internet bubble. So we actually have worse credit ratios for this BBB debt, which is really, really high. A lot of this BBB debt probably shouldn't even be BBB. It should be over here in high yield. The question then becomes, when this is downgraded to high yield, will the Fed go in and prop up those companies? Because they were BBB before they were downgraded, will the Fed still lend to them? If not, you could have a lot of corporations just failing, and then just the number of people who are laid off just, they don't come back, okay? Okay, to make the matters even worse, there's a huge amount of debt maturing in 2019, 2020. So this is the total amount of debt. This is 19 and 20. You look at this, there's a huge amount of debt maturing here. Why? Because interest rates went down after the financial crisis, and a lot of corporations refinanced their debt. The average time to maturity of debt is about 6 years. So 6 years from maybe 14 is 2020. So we have a lot of debt now maturing. Now, the Fed has said they'll issue debt in the primary market directly to corporations, and they'll actually buy up the bonds as they're trading in the market. This is not a good situation for corporations long term. Ones that are already levered up, they're going to be more levered up. And assuming they don't buy the high yield bonds, those companies will just fail. Now, that's 22% of the bonds outstanding. That's a lot of business failures. A lot of business failures. All right, let's see how the market's been reacting to this. So on the high yield side, fixed income slides. This is Bank of America's high yield interest rates versus the 10-year Treasury. The difference between high yield and the 10-year Treasury is the extra interest rate you get to invest in risky bonds to compensate you for the risk of default. I mean, the 10-year Treasury, we assume the US government will not default. So this is the extra interest, the blue line. You can see here, this is a recession. The extra amount of interest that was required was about 10%. Now, in the financial crisis, it went to maybe 15, 20%. I cut off the top just because, otherwise all these other points in the line look like not too high. Where are we now? This is daily, it's 10.7%. This is on the high yield bonds that the government's not buying. Clearly, we're pricing in some pretty darn dire outcome. Right now, this was 2015. In 2015, we had energy. Oil went from $100 a barrel to 25. Oil right now is at $22 a barrel. And we had kind of a recession in the manufacturing side of the economy. And a lot of the high yield bonds were in energy. So this rose quite a bit here. But no, the Fed came to the rescue and the economy recovered. This is not, I assume, not just energy debt that's blowing out the spreads. And you can see this is negatively correlated with the black line, which is industrial production. So high yield basically saying, hey, things are pretty higher. But it's not just high yield. It's munis. So munis are bonds issued by state and local governments. Okay, now muni bonds have an advantage over treasuries because if you lend money to state and local governments, you don't have to pay the same taxes you would have to pay if you lent money to the U.S. government. So there's a tax advantage. But what you see here is normally, however, the muni, the states, have more risk than the federal government. But you can see in general, the blue line and the red line, the black line kind of move together. Sometimes the muni interest rate is higher than the treasury rate, and sometimes the muni rate is lower than the treasury rate. The spread is here. So over this period of time, even though munis have a tax advantage over the treasury bonds, they were trading at a higher interest rate, probably because they have some more credit risk. Look what's happened recently. People weren't willing to lend to state and local governments. Why? Because they have more risk. So the interest rates for state and local governments who are going to have huge deficit, unemployment insurance, whatever else they're doing in order to help out their economies went way up. Part of why the feds come in to provide liquidity, cash to the markets, put the money in the cash in the bank accounts, and maybe people buy up these bonds. All right. That's one thing. Look at the mortgage. So housing is not a large part of the economy, but it impacts a large part of the economy. So let's just say housing is, impacts 25% of the economy through housing starts. If someone buys a home, they buy furniture. the person who actually makes the home has a wage, they buy hamburgers, etc. So let's just say, and the housing is a huge portion of people's net worth, especially as you go to the lower end of the spectrum. Typically, let's look at this. This is return. This was spread over here. This is the returns of the mortgage-backed security markets versus treasuries. You can see mortgage-backed securities returns have just fallen apart here recently versus treasuries. We'll go up and look at what's happened in the bond market overall. Year to date, long-term government bonds are up 24%. Interest rates have come down on the long-dated bonds. Interest rates go down, prices go up. However, remember the spreads on high-yield bonds have widened. So the spread widened from, let's see, about 4% to 11%, so that's 7% widening. So even if the treasury goes down 1%, the spread widens 7, that means interest rates on high yield bonds, 7 minus 1 goes up 6%. So high yield bonds are down 12% this year. Looking at mortgages, the mortgage spreads also risen. So interest rates have gone down, but and mortgages tend to be a little bit longer term. However, people do refinance and move. They're only up 2% versus the long-dated treasury up 24%. Now, mortgage bonds move when interest rates on treasuries go down. Mortgage rates normally go down, but they haven't gone down nearly as much because the spreads widen. Why? I told you a little bit earlier what's happening in the repo market, the mortgage market, and all those other things. People think there's more risk, so the spread has been widening. So that means in order to support the mortgage markets, the Fed lowered, basically the Treasury, they're buying up treasuries, now they're buying up mortgage securities in order to push up price, lower the rate on the mortgage-backed securities. But just because they lower the rate on the mortgage-backed securities doesn't necessarily mean that money feeds through to the ones that are actually lending the money to the people. So let me show you this. So remember, mortgages have underperformed treasuries. So what's happened is the mortgage spread here, this is the mortgage-backed security has risen, right? Fed needs to go out and buy up mortgage-backed securities to make that spread go down. But the ones that, basically the bank lends you money for a home. They sell off your home into a mortgage-backed security, right? So the rate, that's trading on a mortgage-backed security rises if people aren't willing to lend, but the bank is totally not willing to lend because the spread here to treasuries rose way more than the spread in a mortgage-backed security, and that, as far as I know so far, the Fed can't actually lend directly mortgages to consumers. So basically, if they buy up mortgage bonds, hopefully that puts cash in the system, and then the banks will eventually lend to that cash that they get, lend to homeowners, and then that interest rate will go down. Right now, it's just the market is frozen up. It's just not working. Is this reasonable that the spreads for munis, the spreads for high yield, the spreads for mortgages have widened out? So let's take a look at that. What typically happens in a recession to default rates? So I showed you, and this is not as recent as what I just showed you, which was updated through yesterday. Credit spreads have now widened, and mine was a high yield, Bank of America high yield bonds, so this may be a little bit different. Oh, wait just a second. I may want a different chart. Okay, there we go. Moody's speculative investment grade, so US high yield interest rate. This interest rate says it's 9%. This is an option adjusted spread. It's probably even gone higher since this has been posted. What is the default rate on bonds? So let's say you get 10%. That's assuming you actually, everybody pays their interest on time, okay? Back here in the financial crisis, you may have been making 15% on your high yield bond, but your default rate was 14%. You're getting paid a higher interest rate, but then people weren't paying you. Now, with that being said, when corporations default, that means they don't pay on time. That doesn't mean you get zero from them. Maybe your recovery rate's 50%. So if your yield is 15% and 14% of the companies are defaulting, but you still get 50% of that back, that 15% only, half of 14 is 7. That 15% drops to 8. Still pretty darn good. Now, in this particular case, we would expect the default rate on homes to start really, really rising, which is probably another reason why the fiscal policy, the federal government's come in and trying to provide some financing and directly to the consumers, so this doesn't happen. And it's been just amazing what they've done in such a short period of time, which of course is the reason why the market was up 12% this week. Let's go back to the outline. All right, now let's take a little look at the coronavirus situation. Look at the numbers in China, Italy, and the US, and I'll give you a little bit of comments from something I heard from another firm here recently. So this looks at the confirmed cases, and Evercore ISI, their China analyst, was looking at when did the number of cases peak in, say, China, day 28, day 30. When did it peak in, let's see, which one is this? This is China total cases. This is active existing cases, sorry. It peaked in day 28, day 30. This is total confirmed cases. Total confirmed cases in China when they flattened totally flattened this, where they didn't have really any more cases, took about day 42. Look at our curve. We're not flattening at all yet. The problem with not flattening is that could potentially really hurt the healthcare system, and there could be real deaths. And until it flattens, we really can't get back to work quickly, which means unemployment can continue to go up, more companies can fail. Let's look at the numbers a little bit more closely, and this time we can look at also what's happening in Italy and compare it to what China did. Now, in order for China, this is just, this is China, and one of the biggest impacted provinces. It started in January 15th. By the time you got to day 28, the number of new confirmed cases, this is change in confirmed cases, peaked. I believe they had a change in some accounting or how they were recording cases at that time. That's why it was such a big jump, but basically peaked in day 28. Where's the US? At day 28 in the US, this is where we're at, starting on 2/20. We were nowhere near peaking. This is yesterday's, 16,000. But it's kind of roll off here. Now, what we don't know for sure is really when it will peak in the US, because we don't have adequate testing to test everybody. So it could peak sooner than we will know because we don't have the testing. Now let's look at Italy. Italy also start 2/20. Italy, basically closed down the whole part of the country. The US, we have different states with different standards of what they're closing down and making people stay home. The states that aren't doing it probably don't have as many cases, but that means it just will fester and get worse in those states, which means they can bring it to our states. China, just I think yesterday, basically said no one in the country. unless it's diplomatic and you get screened at the airport or something like that. Why? Because now that they've controlled it in their country, they basically want to make sure no one from outside the country brings it back in. As long as we can move from one state to another, the states that are not basically keeping their people home, they'll just come across their border and it doesn't matter. Yeah, the whole country really needs to do this, or it really doesn't work. So go look at Italy. It looks like by day 35, they're starting to get this under control, because it looked like the number of confirmed cases was 6,557 and day 30 there, and this is 6,153 yesterday. But ours are just exploding. I'd argue until we have a situation where everybody just stays home, this could continue growing. It'll be different in different states, but again, as long as people from one state can go to another, and the states that aren't making people stay home can infect the people in the states that are making people stay home, or they just have to stay home longer, right? Give you an idea of another country. I was communicating with someone in Singapore, I believe it was, and talking about us shutting things down and making people stay home in Wisconsin. This was earlier this week on March 24th. I believe this person was in Singapore, and she said, oh, we've been WFH, work from home, since January 24th. They've been home for 2 months, and she figured there would be another couple weeks. So can we open things up really quickly? Well, not if we want to control this. It seems like, based on other countries. Korea got their things under control really, really quickly. Listened to one call recently on why it works so well in Korea. Well, as soon as things started to unravel in China, the government already had some partnership with private institutions that private corporations basically partnered with the government, and the government said, hey, start making tests immediately. So when it came to South Korea, they already had the tests ready, and they gave people the tests, and then they separated them. Now, I've read two different articles, one by Howard Marks and another one, I don't remember where it was, but I think one of them said that they tracked their people in South Korea by their phones. Another one, I think, that I read said they put maybe a device on their hands, so anyone infected will be tracked. In China, I read several different articles that said they even took their people away from their family. Why? If we quarantine at home and someone in my family gets coronavirus, you have to assume everybody else is going to get coronavirus. And the reason why is it's going to be very hard to not get anything dirty and someone picks it up. That's only going to flatten the curve for however many days or months it takes for everybody in my family to get it. Now, the problem is, during that period of time, even if we don't get it bad, someone could go to the grocery store, which then still infects that person. So China did this in record time to flatten the curve and reduce it to basically zero more people getting this, because they really took this aggressively. In the US, can we do this? We think of freedom. I've received some emails this week from someone that says it's absolutely terrible that we're making people stay home. It's just against our natural freedoms in the country to be told that we can't go out and go around. Look at the number of new cases in China right now. So if we do not do this, it's just going to be around with us for a month or two more. Now, there are some positives on this. What if we get a test? I've heard one person said could be 10 times as many people who've had it than showed symptoms. That means a lot of people could go back to work. In order to get them back to work, we need to get an antibody test. An antibody test basically tells you, do you have it? You generate antibodies to the virus if you have it currently or you already had it. If you can give a person an antibody test, they'll say, oh, you either have it or you had it. But then you give them the other tests to see if you have it. And you say, oh, you know what? You don't have it. You know what? You already had it. You're immune to it. Go back to work. If we can get the testing done, we can get people back to work pretty quickly. So hopefully the government's really working on getting the testing done. So what is the recovery on the other side of this? So McKinsey did a piece this last week talking about the two main things in order to have a strong recovery. One is flatten the curve, right? You need to flatten the curve for multiple, if you actually made the curve go way up, you basically get the virus through everybody really quickly and you probably actually shorten the time period. But a lot of people would die in that because you would tax the healthcare system. And on top of that, I listened to one epidemiologist said, if you just let it go through the system, there'll be more of the virus. People will not be getting treatment correctly. And the virus has a greater chance of mutating because it's just a numbers game. The number of viruses, X number probably mutate. And he basically said your economic repercussions could be way worse because if it mutates, we may be with this for the next 10, 20, 30 years. So he said, this is really not a good option. Just let it go, come down. Even if you didn't care about people's lives, this is a really bad one. The amount of lives will be lost. So you want to flatten the curve. The problem with flattening curve is, then people are out of work longer. But you limit it so that the healthcare system can manage it, and you can, basically you save lives. Okay, and you may even save the, fewer the virus. This way, because if you get really, really sick, you probably actually have more of the virus in you, which again raises the probability that it mutates and it's with us for many years. So we're trying to think about, all right, but when you do this, GDP goes down. So that's imperative too. Safeguard lives, livelihoods, safeguard lives. McKinsey points out if we do both things right, we can have a V recovery. And I haven't really formed my initial opinion on this, but I don't really think I disagree. So if you basically make everybody stay home, you save lives, you make the economy really, really bad and sharp contraction. But if you also have an effective policy response, so you basically make people stay home, no one's working, but you have a really good policy response supporting consumers, supporting businesses, you get the V shape. Looks like the kind of one that we're doing right now because we have, some states basically making people stay home, some not, and various things. So if you have a really good policy response, which sounds like that's what we are, okay? But you kind of have, a little, not quite totally effective. It looks like this, okay? So it's a little bit more of a U shape. It takes some time. That's probably a good guess of what will happen. Let me go back to my outline and explain some things too. So one of my students, very bright student, sent me an email. He said he was reading an article or listening to a video. He said, isn't all this quantitative easing, this cash going in the system, couldn't this be inflationary? And I said, oh my gosh, you are absolutely right. It could be, it may not be, but I'll tell you in a minute that no one's expecting inflation. I'll show it to you in a minute based on looking at financial markets. So money supply, this is our equation from economics. Money supply times velocity of money equals price, which is inflation times quantity. This is just the cash in the system. If the Fed goes up and buys up mortgage bonds and treasury bonds, they put cash into the bank accounts, cash into people's pockets. That cash has to go somewhere. If it doesn't show up in quantity, basically, buying units and stuff, it would show up in price. If it doesn't show up in price or quantity, it basically means this velocity must be going down. Basically, people are saving the money in cash. And it's not putting the money in the stock market because the stock market's been going down. Probably not putting money in the high yield bonds because the spreads are widening on high yield bonds, but it's just putting it in good old cash. Eventually, what the students said. When we come out of this, a recovery, and people go back to work, one of my favorite things to do is I go running during the day with my Jack Russell Terrier so I can go out to eat. I'm going to be going out to eat, so there are not many times I'm going to have to run a lot too. But what's going to happen is I'm going to go out to eat. If people are not fully back to work when I'm allowed to go back to eat, then the ones going to work, they're going to get pretty high wages. And if the ones aren't in the field or whatever making the food, if there's not enough supply of workers and not enough supply of inventory for the things that we will buy at retail stores and every other place, that means demand when we come back could be way, way greater than supply, and that could push up prices quite substantially unless the Fed comes and lowers money supply growth really, really quickly. Of course, we'll get more quantity out of it as people go back to work, but you have the possibility of prices really spiking up. Now, of course, that money supply may not lead to prices go up if people start lending up. Now, if the velocity, let me think about this a second. Well, mathematically, the only way you wouldn't have a high inflation and high quantity if money supply is still good when we're coming out of this is if all of a sudden the velocity money went down, okay? And it would have to go down even more. The Fed last week, I can't remember last week, this week, they basically said the required reserve requirements, I believe, I'd have to go back and check this because I only heard it, I didn't read it, and didn't go to their website. Basically, they said required reserve ratio, don't worry about it. Well, all of a sudden, the required reserve ratio goes back up to normal. The velocity does go down. And so even if they mistakenly leave the money supply growing quickly, if they reenact for the banks, say you need to have so much cash in your vaults, which is the required reserve ratio in order to lend out, that could end up making the velocity go down and you don't have price inflation. But we have a really possibility of this. So if nothing happens on V, money supply keeps going up really quickly. People start spending money, but you don't have enough workers and inventories have been run down. Now inventories may be run up because maybe plants keep producing some during this whole period of time, even though people aren't spending because they're retrenched or worried about their jobs. So it could be when you come out of this that inventories are pretty high. So when you get the extra demand, you don't have where demand's outstripping supply. But let's say inventories are not high coming out of this. Now you're going to have a really high demand, maybe not enough supply because it takes some time to get the supply chains working again to create that inventory, and you could get a lot of really high inflation. If that happens, really high inflation, interest rates rise. Remember I said the consumer was okay off on the financial obligation ratio, partly because interest rates are low. All of a sudden the financial obligation ratio goes up. Corporations, which already have a lot of debt, their interest rate rises. The US government just has a huge amount of debt, it's getting bigger rapidly by the day, interest rates go up. That's a really difficult situation. And on top of that, one of the Fed's goals is to keep inflation not too high. So oh my gosh, under the worst case situation, you come out of this, you get really high inflation. Now the Fed has to raise interest rates really quickly, which puts us back into a recession. So is anyone expecting higher interest rates, or sorry, higher inflation? Let's go look at what the bond markets are telling us. What you have here in the blue is the 10-year Treasury bond minus the 10-year TIPS. The difference between the Treasury and the TIPS, the only difference is that Treasury inflation protected securities protect you for inflation. They have all the exact same risk except for that. So the difference of the 10-year minus the TIPS is the implied inflation rate embedded in the bond market. The implied inflation rate embedded in the bond market went to 0.5%. The market's not expecting a rise in inflation. Actually, the black line is actually CPI, the headline number, not excluding food and energy. So people right now are expecting inflation to go way down. So that would be a huge surprise. All right. So if inflation rises, typically when inflation rises, interest rates need to rise. Okay. So this is the inflation rate over time, and this is 1 year change in the government bond. They tend to be positively correlated. So if inflation rates rise, you would expect basically interest rates to go up. Why is that important for the stock market? Well, let's talk about what the market's saying. When this all started, we had very high valuations in the stock market. And those valuations, the PE ratio is highly dependent upon the inflation rate and interest rates. So what I have here is the 10-year government bond yield, and I have the cyclically adjusted price to earnings ratio. So basically price divided by the last 10 years earnings. If price is high relative to earnings, that means people are expecting really high growth for their earnings, or earnings to be a very low risk. As interest rates go down, multiple reasons why the price you would pay for earnings goes up. Well, if interest rates are down, you can't make much money in bonds, so people buy stocks. That pushes up the price on the stocks, and if earnings don't change, the PE ratio rises. Look where we were right before this hit. We are at a very, very high level, okay, of PE. This goes back to 1872. All these points are different months along that period of time. If interest rates, inflation goes up, I'm not saying it is, because the velocity could change and we could be building inventory along these next few months. But if inflation rises, which is a risk, so if inflation rises, interest rates go up, PE tends to go down, which means, you could be in for a market correction after a huge correction. So what has else been happening here recently? We've had huge factor and sector rotations over the last month and a half. It's been amazing. So let me show you this. So first of all, factor rotations. In times of stress, people will rotate to quality companies. Quality companies tend to have a high return on equity, high return on asset, high return on capital, and high profit margins. They tend to be more of value-added things that people like to have. What this looks at is a long short of high ROE companies versus low ROE. So right here, before this crisis happened, those outperform, so high ROE outperform lower ROE by about 2% to 3%. It's 102.7 up at that point in time during the year. When the crisis hit, the quality, that 103 went to 116. So even though the market at this point was down maybe 35%, the high quality, high ROE, while they outperformed by 13%, they're probably only down 22. The high ROA, even a greater. The high profit margin, a little bit less. High return on capital, this went from 100 to 116, same thing you're seeing here. So quality, there was a huge rotation of quality, but look at this last little thing. This is the last week. Maybe the market is starting to think, of course, the stock market rallied this week, but even the types of stocks that rallied this week, when this goes down, that means low quality started to outperform. Last Thursday, I have a bunch of stocks on my screen of ones I've been getting crushed. And I noticed last Thursday, even on up or down days, they were doing better than the market on up days, which are risk on days. You would expect the ones beating up the most would do that. But on down days, they really weren't down that much more. So something changed. It's like the losers started to bottom a little bit at that time. So let's look at another graph on this. So this is the S&P 500 versus home building. Well, of course, no one's going to buy a home. They can't get a mortgage. The 500 is going to outperform the home builders. But what happened over the last week? Hypermarkets, I assume this is supermarkets. Of course, there's run on toilet paper and stuff. That's this. But look at, they started underperformed. This is versus S&P over the last week. Household products did very, very well as everybody went on and bought the toilet paper. But over the last week, it's starting to rotate. So it's not just factors of market quality, not quality, but it's also the sectors that are starting to rotate as well. Let's take a look at one more. This is utilities. You know, you're going to pay your electric bill. Hopefully you get your heat at the moment. They were outperforming semiconductors, you know, pretty cyclical thing in technology. And this went from, let's see, 0.7 to about 0.9, outperformed by 15% over that January 20 to March period. And now they've given up in 3 days. I think this is probably through March 24th. Basically, the market internals started bottoming before the market bottom. So it's the 27th today. It's been a huge rotation to risk on the last few days in sectors. Let's go back and look at the macro model I've developed. So this macro model here, multicolor, it tracks the economy. There's consumer factors, business factors, monetary policy factors, and lending factors in it. This basically, all these points of time are associated with recessions. It looks like this is going to a recession. What I've done is I correlated the different sectors of the market with changes in this line. And what you see is when this line is going down, staples, which is the household product, the food, when the line's going down, they tend, it's a negative correlation, meaning they go down less or they actually go up. How about utilities? They tend to go up when the economy is falling apart. Now, healthcare is zero, so it's also quite defensive. If this starts rebounding later this year, and by the way, the market, based on the internals, are telling you that it's going to start rebounding, what do you normally want to be in? Materials, which has the highest positive correlation to this line if this starts to go back up. Industrial companies, financial companies, and consumer discretionary, your auto and your retailer, your leisure companies. So that's, you know, kind of what we're thinking. And when the market is basically saying over the last week, hey, maybe, you know, some of this monetary and fiscal policies are starting to, you know, get us to bottom. Now, this also impacts portfolio management, the value growth rotation. So what I have on here is, let's say the black line is the economy. Whether it's red or blue means is value or growth working. Blue means value is working. Red means growth's working or quality. This period of time, when the ISM PMI, Purchasing Managers Index, is going down, favors quality, which clearly worked well. That's high ROE companies and probably more expensive companies. The market starts rotating to the junk, the value companies, which tend to be more cyclical, cheaper companies because something was wrong with them before you bottom, before you have growth. So if you look here, this is phase 6. If you're less than 49 on the PMI, which means the manufacturing side is shrinking, but you're falling, value stocks outperform. This is a 3-month return. And it's looking at the cheapest companies in quintiles versus most expensive. They tend to outperform by 1%. That's in a positive market, a rising market. In a down market, they outperform by 4%. Oh, it looks like recent rotations, in a few months at least, is favoring this. Last thing I have to talk to you about is what makes market bottoms. have a few articles here. First of all, volatility tends to peak. The losers tend to bottom. I've already shown you that value, semiconductors, staples, we got some rotations happening, that those are bottoming. Let me show it to you, looking at the equity markets here. Over the last week, well, small tends to do better in market bottoms. This is mid-sized stocks outperforming large stocks over the last week. Small stocks are only a little bit better. Value is not underperforming. Look at how much underperformed year to date, about 11%. Over the last week, value and large value versus large growth, they're hanging in there. Still underperforming value, underperforming growth in the mid cap and also in small cap. But, it seems to be way better than it was earlier this year, minus 36 to minus 26, minus 39 to minus 30. So maybe there's some, people starting to think, the value is starting to do well. And clearly, semiconductors are outperforming utilities. Staples are starting to underperform the market. So we're finding some of those things here that are kind of associated with a bottom. The other thing that is associated with bottom is the losers. Oops. Let me find this for you. Pause it for a second. The losers tend to stop going down. If we look at the financial crisis, this is financials relative performance as a financial crisis, a banking crisis versus the market. So the gray line is the market return, all right? And the green line is how financials do versus the market. When financials stop underperforming the market, it's when the market went up. The stocks that went up a lot this last week are restaurants. Actually, I don't have any of those on my screen, but Carnival, Royal Caribbean, Boeing, airlines, hotels, ones that provide food to restaurants. Those tend to have to go up according to this before the market really is sustainable rise. This is the tech bubble. Tech corrected, but when tech started to outperform again, the market went up. This is energy in 15. Energy stocks, oil, bottom. This is not on a relative basis, and then the market rose. Because it was really in 15, 16, it was kind of a manufacturing recession caused by low oil. So it kind of has to be the ones that are doing really, really bad have to stop doing so bad. It's almost like they found a bottom, and then the market can also find a bottom. One other study, just to give you some food for thought on this. This is looking at implied volatility, option volatility. We started kind of with volatility, we'll end a little bit on volatility. When the VIX goes up, basically a measure of volatility of the options markets, I think it's 30 days for S&P 500 companies. Generally, the market goes down. But the market, that may be a temporary bottom. But when the VIX starts coming down, meaning volatility starts to come down, and basically the market takes some time to make the last bottom. This was 2008. This was 2011. VIX rises, market's down. But it was a few months later, VIX kind of went up again, and the market finally made its bottom. This is 2015 with oil. VIX, market falls off. Once again, we had to have a second bottom. Same here in 2018. So people are wondering if this recent rally this week, which now, since the market's closed, rallied 10.26% this week. At the beginning of this call was, I think, up 12%. Maybe that was, kind of a bottom fishing and people buying and maybe this can go back down. That's what a lot of people are saying is kind of normal. Where will this actually peak? Well, it's probably when we're sometime through this. when we get some kind of certainty in how long we have to stay home. What's the best returning market this year? I have the 500 large companies, 2,000 small companies in US, emerging markets. These are all pretty bad. Europe, and then China. Why is China the best performing market of the year? Well, I told you earlier, their number of caseload on coronavirus looks like it's peaked. And now they're shutting off their, so people can't travel in and give it to them more. Now this week, they're only up 5%. And Europe and US are up much more. Looked like the change in cases in Italy are peaking. Probably the reason why the 500 is up because of the very significant monetary and fiscal policy. Is this over? Looks like we definitely have a few more months of it. You could potentially have a lot of companies go bankrupt, especially in the high yield space if the Fed doesn't come in and lend to them. Unfortunately, until we, in my opinion, this is personal opinion, until we basically tell everybody to stay home and really quarantine it, we're probably just going to keep on creating way more cases, and hopefully we don't overwhelm the healthcare system. I'm worried that we will. Anyway, something extremely difficult to deal with. I hope that this session really helped you understand what's going on in the market. Why is the government doing what they're doing? What may be happening to companies? Why are the financial markets operating as they are? And I hope very much that you're safe in this coronavirus crisis, and that your families are as well, and your friends. And we all make it through it. We all have good jobs, and the market's off to a new high once we're through it. So that'd be the absolute best case scenario, and that's what we can hope and pray for. Have a great day.